Good morning, distinguished ladies and gentlemen. I'm Florie Lazier, President and CEO of Corporate Council on Africa, CCA, the leading U.S. business association focused solely on connecting business interests in Africa. I want to personally thank you for taking the time to join us today in the second session of our three-part Africa Finance Forum webinar series entitled Blended Finance, Catalyst of Africa's Post-COVID-19 Economic Recovery. Now, in the last 10 weeks or so, if we've been taught anything, it's that government and the private sector must find new and better ways to do more with fewer resources. And in these strange times where we have to come together virtually instead of being able to do what we always do, which is engage face-to-face. This Africa Finance Forum will endeavor to highlight the strategic role of blended finance in post-COVID-19 Africa. And I'm grateful to the African, US government, and private sector leaders who will be sharing their insights on how their institutions are leveraging blended finance in these challenging times, and the many more who will be zooming in during the three sessions. I promise that this forum will be worth your time, and I'm deeply thankful to our sponsor, Citi, for their support. Our session today, Blended Finance 1.0, Putting Development Capital to Good Use, will emphasize the need for governments, development finance institutions, and philanthropic organizations to leverage their assets and develop new partnerships to achieve measurable impacts while using limited resources. We look forward to a rich and insightful conversation among our panelists who are playing a critical role, each of them, in addressing these issues. I would like to acknowledge and thank Maureen Harrington, who's the head client coverage for financial institutions, USA for Standard Bank, who will moderate this session. Maureen has a long and rich history and experience working with corporates, international organizations, and governments. I first met Maureen when she was in the US government, and she has that expertise in helping develop some of the solutions to achieve the financial objectives that companies have. But before I turn the webinar over to her, I want to go over some housekeeping rules. During our question and answer period, please use the Zoom chat function to send us your questions. We'll only take questions from those who have provided their name and affiliation. So please, when you send in your questions, give us your name, first and last name, and your company or affiliation so that we'll know how to call on you. Maureen, over to you.
Thank you, Florie, for the very kind introduction and for giving me the opportunity to be here today. I think it's a really important topic. Let me start by introducing our panelists that we have with us today. I think the Corporate Council on Africa has put together a great team of all the key stakeholders represented in a blended finance approach. And I think as such, we're going to have a very rich discussion because people can bring together their different perspectives on this particular topic. So representing government, we have His Excellency, who is the Minister and General Delegate for Entrepreneurship from the Republic of Senegal. From Development Finance Institutions, we have Michael Awori, who is the Chief Operating Officer from the Trade and Development Bank. From Philanthropic Capital, we have William Asiko, who is the Managing Director of the Africa Region Office at the Rockefeller Foundation. And from Private Sector Capital, we have Mamadou Bitte, who is the Vice President for Social Impact for Central Europe, Middle East, and Africa at Visa. And we all know that the blended capital approach is becoming more important because not only is there a need for capital in a post-COVID-19 economy, but also the need to remove pressure from governments to do it all. Not only is it important for government and official capital to be leveraged, but it's becoming more and more possible Firms are looking for ways to become more relevant in the communities where they operate, and customers are demanding it. Quite a bit of evidence is there to suggest that ESG investing, for instance, is outperforming traditional investments. We are learning that you can make a difference and make a return at the same time. So how can we mitigate risk using development capital in a way that's going to facilitate more commercial flows to the continent for development outcomes? I think today's panel is really important, and hopefully we can get to some of these issues. So I would like to start the questions with the Minister. Mr. Minister, I understand that 59% of the population in Senegal consider themselves aspiring entrepreneurs. As the Minister responsible for entrepreneurship development in Senegal, you have a unique opportunity to utilize the capital that's available for blended finance in your ministry's strategy. Can you please tell us about the role of blended finance in your work at the ministry and how you're supporting entrepreneurs in Senegal?
Thanks, Maureen, Flory, and Mamadou. Hi to you, Michael, and everyone on this call. I'm really happy to be taking part of this conversation today in this particular circumstance of COVID-19. We can't even say post-COVID because it's still on. Hopefully, it will end soon. And I would like to thank the CCA for putting this together, and to go straight to the question you asked me. I would like, first of all, to quickly say a couple of things about what we do here at the General Delegation of Entrepreneurship at the Presidency. We support young and female entrepreneurs, supporting them with capital, guarantee, debt, equity, but also all sort of technical assistance. And among those part of initiatives, we've been able to invest around $50 million a year over the last 2 years. And alone these last 6 months, we've been able to, how could I say, invest at least $30 million to support entrepreneurs, mainly in the agriculture sector, for a resilience package we've been able to put together to support the young entrepreneurs, women, and startup institutions. And it appeared for us that blended finance would have a catalytic role, in a sense that it will allow us to put 50 or 40% and ask our counterparts, banks, and other microfinance institutions, and sometimes technical assistance corporations like USAID, French Development Agency, other institutions that put a grant or concessional loan to support our operations. For instance, it has been able to leverage more funds to address the demand from our entrepreneurs, raise the interest for this target among the financial sector, and not only also induce the charges in the financial sector for more inclusion and lower interest rates for the credit we put together. And finally, it helps us a lot to scale up the investments we do to reach a wider audience, but also to invest in sectors that we won't be able to do without those blended finance. I would take examples of like cold storage facilities for fishermen. I would take also the case of a storage facility for people who produce the cashew nuts, but also horticulture sector, onions and potatoes, etc., etc. Without those blended finance mechanism, we wouldn't have been able to do those investments. And I would go further on later on key particular details. For instance, we've been able to put together a 12 billion CFA, around $25 million blended finance facility with us, and the Agriculture Bank of Senegal, but also the National Economic Development Bank and 2 microfinance institutions to support this year the crops and the storage and the transformation of cashew nut in the south of Senegal, mainly Casamance region.
Thank you. it sounds like you've been very successful in finding ways to leverage bank funding in Senegal and using your capital to help actually bring down the cost to entrepreneurs as well.
Exactly, indeed.
Thank you. Next, I'd like to ask Michael Awori about the Trade and Development Bank structure. In some ways, your organization is a great example of blended finance in your structure and business model alone. Can you please tell us about the Trade and Development Bank model and how you blend various sources of regional and global capital to deliver high impact?
Thank you, Maureen, and thank you, Flory, and the rest of the CCA team, and greetings, Honorable Minister, and the rest of the my esteemed panelists. You're perfectly correct, Maureen. Sort of blended finance is really in the TDB's DNA. As a commercially oriented DFI, we raise capital from our member states, who are our primary shareholders. We also raise institutional capital from pension funds, insurance companies, sovereign wealth funds, regional and national development banks, and other institutional investors from across our region in Eastern and Southern Africa, but also from across the globe. And we supplement that with commercial capital that we raise ourselves via the syndicated and bilateral loan market, as well as the capital markets, where we are a regular bond issuer. And we intermediate or blend those various sources of capital into our operations and channel them to fund various interventions across our region, all targeted to achieve triple bottom line returns. For example, in our short-term trade finance business, which is the largest component of our business, we've deployed significant amounts of capital to facilitate the import of vital commodities such as wheat, grains, fertilizer, and fuel, to ensure that our region has the inputs necessary for economic activity, in addition to enhancing productivity levels in agriculture to boost our food security. We also play a critical role in addressing trade finance shortages, as well as Forex challenges, providing dollar liquidity to facilitate greater levels of inter and intra-African trade and regional integration. And we do this with a relentless focus on efficiency and innovation. And we've scaled up this business, actually, in light of COVID-19, particularly through the use of technology to address some of the disruptions we're seeing in the physical movement of goods. In the long-term part of our business, the project and corporate finance business, we've financed numerous manufacturing projects, facilitating infrastructure development and creating local jobs. A particular focus area in our long-term business is energy. We recognize that Africa needs efficient and affordable electricity to facilitate our industrialization ambitions. Over 70% of our existing portfolio is in renewables, and we're ramping up our emphasis on green energy projects, particularly in the solar, hydro, and wind sectors. And I'd say our blending also goes beyond providing the financial capital necessary for projects to get off the ground. We also deploy our intellectual capital via our advisory services, where we help sponsors get projects to bankability or advise our sovereign clients on debt sustainability, for example. And through our partners, we also provide technical assistance for feasibility studies and the like. So TDB is the nexus, if you will, between public sector objectives to drive investment in various sectors with the private sector demand that such investment is done responsibly, generates financial and social returns, is sustainable, and delivers impact. So these are just a few of the ways that as an institution we go about doing this.
Thank you, Michael. It's interesting how the source of your liquidity is blended finance to start. Just a follow-up question, are you applying blended finance approaches in your investments as well?
Absolutely. So blended truly is in our DNA. So every intervention, by nature of our institution and the way we're funded, has a mix of these different sources of capital and is viewed through not only a developmental lens, but I'd say also an SDG lens as well. And then the instruments that we deliver will cut across from funding, as I mentioned, to sort of your technical assistance and other ways to ultimately ensure that projects are successfully executed.
Thank you. Has William joined us?
Yes, I'm here.
Oh, perfect. Hi, William. Next, I'd like to discuss how philanthropic capital plays a role in blended finance. And we have with us today William Asico from the Rockefeller Foundation. And William has an interesting background. He has looked at the issue of blended finance from a number of perspectives. I know in previous roles, you worked with Grow Africa, which was a collaboration between the World Economic Forum, AU, and NEPAD. You've also spent 20 years of your career at Coke, both with the business itself and also the foundation. And I'm just curious about your perspective. I know that the Rockefeller Foundation has a particular interest in partnering with the private sector to provide concessional capital to de-risk different opportunities. Can you tell us a little bit about this work and where you have seen the most success in using concessional finance to unlock commercial capital?
Thank you very much, Maureen, and thank you to CCA, Flory, and the rest of the team for giving me this opportunity to share some of my thoughts around this very important subject. Let me start, first of all, by applauding the remarks by the Honorable Minister and by Michael regarding the work that they're doing in their respective areas and sectors, because this is exactly what is needed. The challenge, of course, is how do we do this at scale? How do we make this work transformational? And I think we have seen with the MDGs originally and with the SDGs that the traditional methods of financing development, particularly in the world's poorest countries, has been inadequate in many respects. And you did say that I've had a unique opportunity to look at how the private sector mobilizes capital, because I spent 20 years working for the Coca-Cola company right here in Africa. And part of the work that we did was to mobilize capital for our business on the continent. And when I look at the way the private sector mobilizes its capital and the way development is financed, there are stark differences. And you can begin, if you look at these differences, to understand why, on the one hand, the private sector is able to mobilize billions of dollars to do deals in a very short time. I mean, if you take the 5 top largest deals, mergers and acquisitions deals that have been done in the world in the last 20 years, it's nearly $1 trillion that has been mobilized by the private sector to do these deals in our lifetime. But the traditional methods of raising development capital are just not going to get us over the line. And so we have to start thinking different. And of course, blended finance is one of the solutions. The challenge, of course, is that those who lead development institutions and those who lead public sector institutions and those who lead private sector institutions don't always speak the same language. And they're not always motivated by the same thing. And therefore, you sometimes have some tension between the three. And the question is, how do you address the motivation for each of these institutions to come together in a blended finance model to finance development at scale? And I have a few examples. I mean, obviously, one of the biggest challenges that I certainly have seen since I started working in this sector is how development capital is channeled. So one of the most common ways that historically the largest chunk of development capital has been channeled as budget support to governments. And this has not always been optimal. It has sometimes led to inefficiencies and has not always produced the desired results. And so we really have to think, if we are going to go into a blended finance solution, how do you channel these resources? The second thing that you have to do is that because the private sector is so efficient at raising capital in some of the ways that Michael mentioned, you've got to, in the development sector, begin to speak the language of the private sector. if you're going to attract this capital into the sector. And so you have to be very disciplined in your approach. Projects need to look like investments to the private sector. They need to be packaged in a way that the private sector, private capital, commercial capital will be interested in going there. Now, one of the things that is growing and has been growing for some time now is impact investment. This is where commercial capital is a little bit more patient and a little bit more risk tolerant than it would ordinarily be, and therefore can be used to invest in development projects. However, this isn't enough. You have to go further than that. I think that in order to attract commercial capital at scale, where philanthropic capital can help is to provide mechanisms to reduce the risk for commercial capital, and also to reduce the waiting time for the return, so that the commercial capital can be interested in that particular project. And so what we have done at Rockefeller, for example, we have set up an impact investment management platform. It works on private sector principles. It works with leading asset management companies on Wall Street. It uses these to raise capital. We, as the Rockefeller Foundation, put in seed capital of $13 million. And today we have leveraged that $13 million to attract over $350 million in commercial capital to fund projects that are in support of the SDGs. So that's just one example. There are many. There are program-related investments. But one area that I did want to speak about, and I think Michael touched on it, is this area of technical assistance. There are many investable development projects that could attract the private sector or commercial capital, but they require technical assistance or expertise in order to get them over the line, in order to get them bankable, as Michael said. And this is a growing area in which I think philanthropic capital can play a part to provide technical assistance, which traditionally commercial banks and commercial finance will not look at. They want the project to come to them in a form that it is ready for investment. And so philanthropic capital can play a crucial bit in providing this technical assistance and making those projects bankable for commercial capital to look at. I'll stop there for now. Thank you.
Thank you, William. It was really interesting to hear about the Impact Fund and the ability that Rockefeller has had to leverage your own funding for projects. I'm curious, just as a follow-up, could you tell us a little bit about some of the deals that you've been investing in through this fund and how you demonstrate the impact to your investors?
Yeah, so a lot of the deals have largely been around agroforestry and climate change and so on. The challenge always is to make sure that these look like investable deals, and working with commercial asset managers, Main Street asset managers, to invest in these particular projects, bringing impact investors together who are looking for that triple bottom line that Michael mentioned earlier. They're looking just beyond just the commercial capital. They're looking for impact as well on society. And those are the kind of things that we look at.
That's great. I do think that we're experiencing a moment now where impact investing and companies really do want to try and do something meaningful for their stakeholders, for their investors, but also for their staff. Everyone wants to be involved in making a difference, I think, is one sort of positive coming out of the difficulties that we're in right now. More aware. Okay, so now moving on, I'd like to bring in the private sector perspective. And Mamadou Bitte is the Vice President for Social Impact for Central Europe, Middle East, and Africa at Visa. He also has a very interesting perspective, having worked at a nonprofit, a foundation, and now at Visa, and in several regions. So we'd be very interested to hear how Visa thinks about blended finance, and what does concessional capital allow you to do that, but for the concessional capital, maybe Visa wouldn't have been able to do, or would have found difficult without that blended finance approach? Over to you.
Thank you. Thank you very much. My greetings and respect goes to all attendees, to Minister Sarr, and to my other co-panelists. Yes, I'm very honored to really be part of this. So I want to add my voice really to thank the CCA for convening on this very important topic. Talking about Visa's perspective, you know that building inclusive digital ecosystems is what we do. This is particularly important in the current situations we are in particular the situation of COVID-19. So as we see more and more businesses moving into e-commerce and seeing at ways in which actually they could be digitally enabled. But many of them actually find it also challenging to access digital payment. And that's where also I think that the blended finance collaboration with others can make a really big, help us make a really big leap. For instance, some of the projects that you can look at may have of digitization and inclusion, particularly of micro and small businesses, that even ordinarily, not even in a COVID-19 situation, were largely excluded from formal finance. And more so today, how do you bring them at scale? And many of these, the way you can look at it can be actually initially not commercially viable. Because also you alluded to that experience in the not-for-profit. One of the things we realize is that market-ready and market-viable solutions actually allow to reach developmental outcomes at a scale when somebody sees an interest to invest in it, but also can sustain it over time because it is a win-win-win situation. You can say many wins situation, but oftentimes those may have a high social impact potential, developmental potential, but may not be commercially viable initially. And this is where actually philanthropic capital or even public capital becomes really important to serve as risk capital or de-risking capital that allow actually to embrace those solutions, test them, deploy them, whilst continuing to innovate on the business model for the delivery of that, so as to actually turn them into something that is economically viable and can spread over. So some of the examples that we can bring is also around, if you wish, digitization of value chains, right? So today, we know that through digitization of payment and provision of data, so many tools such as credit scoring and all of that can be built to provide more information to underwriters so that they can better understand those businesses. They can design the solutions that they need and deploy it to them. So this is where actually, but also putting so that they can provide the financing that the appropriate financing. I think it is really important, the word appropriate solutions to them. But that alone we know is not enough. It takes always more than one solution or more than one input actually to get to the developmental outcome that we are looking for. And this is where I think that what my predecessors here talked about, which is also technical assistance, capacity building, and all of that comes in. And this is something that usually can be supported by philanthropy, by public capital. I would say those who are actually oriented towards developmental outcomes. So it is always important. We are always looking at that intersect, right? That intersection where actually we can have the aligned incentives actually to bring what we all can bring, whether it is expertise, whether it is capital, because it's not always just capital. It is also about expertise, it is about influence, it is about many other things that can help make the most out of actually the investment that we can make. So this is how we are looking at this and trying to build also those multi-stakeholder partnerships that allow us actually to be able to either invest earlier or faster or actually at a scale we otherwise wouldn't have been able to do without that actually foundational sort of input from philanthropic sector.
Thank you, Mamadou. I'm curious, I know that the Visa Foundation has been doing a lot of good work in this area as well. Is it, just out of curiosity, where does this work sort of sit inside of Visa? Is it part of the day-to-day business, this approach to blended finance, or is it in the foundation, or do the two go hand in hand when it comes to looking at these types of issues?
Actually, definitely, that's a very good question because it sits on both sides, right? So basically, our social impact function is made of two arms. And one is, of course, our foundation, which is an independent entity, but also the social impact team, which I am part of and which sits within Visa Inc. and actually works on a day-to-day basis with the business team and the different functions, our innovation centers, to actually look at what are those new solutions that if we deploy them can actually accelerate digitization, and particularly for the bottom of pyramid and those excluded. Or actually, what are those solutions that can enhance that experience and provide many more use cases to those particulars. So it's both, and and our foundation, of course, focuses on impact investing and more of a long-term sort of investment side.
Thank you for that. And I think it was really helpful to hear from all the panelists about your different approaches within your organizations. I think what I'd like to focus on next and give all the panelists a chance to comment on is to talk a little bit about how we can best catalyze the interest in the sector right now and learn from all of your efforts over the years. And it would be great if you could speak to, from your perspective, what are some of the key success factors to a successful blended finance strategy? I think, Mamadou, you spoke a little bit about how the foundation and Visa Inc. are working together, and perhaps that's one, but it would be great if we could perhaps start with the minister and then ask each of you to comment on that, the key success factors to successful blended finance strategy. Mr. Minister, could you kick us off, please?
Yeah, thanks to all for their contribution, and I would like to say hi to my brother Mamadou there in Dubai. I hope everything is fine. Now we can't fly anymore, and that's why I have not been visiting you so far. And to let you know that indeed, for me, the key success for blended finance, I think our brother William mentioned it early on, is a question of, first of all, size. Size matters a lot because in general, why some of the investors, private money doesn't come to Africa because they say there are little countries compared to what we can have in Asia or in Europe. I remember in my foundation days at the Gates Foundation when Mamadou was at the Rockefeller for some key investments in the ag sector, financial sector, or transports and etc. They would always put ahead the question of size. They would prefer investing $100 million in Nigeria because of the size of the population, 120 million, than in Senegal because of a population of 15 million people. This is critical. And someone asked the question early on related to rule of law, things related to competition, but related to governance, skills, and all those key elements have to be taken into account to have a comprehensive and successful blended finance mechanism to work. And as TDB said, over the last 5 years, I would say even 10 years, we've seen that the trends has grown significantly. Now Africa in general has been able to attract more foreign direct investment and private investors that come in complementary to public investment or local private sector investment. So in a nutshell, for me, to have a successful blended finance mechanisms to work, you have to have a coherent and consistent deal flows, sizable, also have teams that can deliver on those, and have also governments locally or local partners that are able to work together with that private money coming from abroad. That's very essential. And for instance, I would always come back to the example of Senegal, the work we're doing right now with the French Development Agency. We've been able to raise a $20 million loan for the next 3 years. And the conditionalities would be that we will be able to bring up to 30% of that amount the French Development Agency put on the table, and we'll be able to raise 30% additional from local partners to be able to invest in productive sectors. Putting that together, we put a technical assistance component to it. A question was raised for training, capacity building, also certification, quality processes, packages, etc., especially in the agriculture sector or fisheries or transport. To show you that for the blended finance to be successful in the sector, we intervene, for instance, supporting private entrepreneurs, individual or group of women entrepreneurs. It has to take into account some seed money that could be concessional, a part of it that could be as a loan, another part would be a debt or a guarantee. So it's a mixture. Of course, when TDB will speak, it will be different from what my perspective is. It will be different from what the perspective of Africa Exim Bank is. It will be different from the DBSA perspective or any other, because the size, again, I come back to the size of the project, depending on if you want to invest in a local farm of, let's say $15,000, or a plant or a toll road of $100 million. But you could do the blending in both sides.
Yeah, it's an interesting comment, this issue around size, because we do find that when we as Standard Bank are engaging with the investor community in the United States, they're looking for massive transactions.
Exactly.
And, you know, some of the deals even that we're doing for, if you look at power or some of the other areas where US investors have been active, you know, we had one client telling us that they were looking for a $100 million minority equity stake in a power plant. And there's just nothing like that.
Absolutely. That's exactly the way I was mentioning that, because in the past, for instance, when I was at the Ministry of Finance, when we talked to Standard Bank or Standard Chartered and all the stuff, we're talking about $1 billion Euro bond, and we'll be investing in highways, toll road, and etc. other project that, you know, the size of the commitment would not be less than 100, let's say 100, 150 million, etc. plus. And you know, today, I'm dealing with requests that goes from, let's say, 150K to plus. So you see, the size different matters, but you still can do blended finance in all those sectors. This morning alone, I was having a conversation for a deal we are about to strike with ACE Global, which is a global depository company that work in the agriculture sector across Africa. And then we're talking to them to invest in storage facilities for agriculture sector in the north of Senegal or in the south. But they're telling us like the minimum investment cannot be less than $1 million. For instance, $600 million. For me, that amount cannot go if I don't have 100 different small projects, just to give you an idea.
Right. So I suppose that's the role that your ministry plays, is sort of creating that facility where, you know, you can look at the small deals, but bring in a big investment.
Exactly. Exactly.
Thank you for that. Perhaps we can move on to see if one of the other panelists would like to comment on this topic. Michael?
Sure, I'll come in, and those are really interesting comments by the honorable minister. I think probably from the TDB perspective, I'd start off by saying probably the biggest differentiator or success factor, I think, is ultimately the willingness to sort of roll up your sleeves and put in the effort that's necessary to separate the perceived level of risk in blended finance from the real underlying level of risk. You know, whether it's corruption or political risk or regulatory risk or what have you, Africa does not have a monopoly on these risk factors. Right? They exist globally, right? But often in an African context, it seems that these factors sometimes get a disproportional weighting, if you will, in the risk-return calculus. And one of the things that we've found ultimately is there's no substitute for, I think, just putting in the hard work necessary to properly evaluate and quantify accurately these risks. And then I'd say it's also, I think, a willingness to sort of innovate and tweak your model as necessary to deliver the impact. Certainly, again, size is a factor, but you know, one of the things that we do as well is working through other institutions, and it's both from a financing perspective to leverage their scale. So we work with institutions, for example, that could reach down and touch SMEs that we may not be touching directly, or women-owned businesses or youth businesses, right? But by providing them with the capital, could be funded or unfunded, we're increasing their scale and enabling them, right, to reach down to some of the other sectors of the economy that we may not be able to touch directly. But then on the other soft or intellectual side as well, I think the minister touched on this as well, it's again sort of the capacity building or the knowledge sharing. So some of the things we do there are sort of targeted workshops. One of the abilities of TDB is to ability to convene private sector stakeholders as well as governmental stakeholders to sort of have a discussion around sort of the overall landscape and what needs to be done to make the landscape more conducive for business activity. So a number of different ways that we can sort of attack the problem where we've sort of found success.
Thank you, Michael. William?
Thank you, Maureen. I think I'll just build on the points made by Minister Amadou and Michael. You know, I find this discussion around risk when it comes to the issue of development quite interesting. Because if I take, for example, the company that I worked for so long on the continent, Coca-Cola, you know, they have a business in every country in the world, except countries that are sanctioned by the United States. And, you know, they are able to price in risk on their investments and still make a commercial return. They are able to determine that, you know, sometimes there are risks that need to be taken in order to be a first mover in the market. And I think if we in development begin to think in this way, I think we can begin to address this issue of risk. The thing is, the private sector has been pricing risk and managing it, for years. And all of you who are involved in the private sector will know this. So if we are able to think about what is, I believe that the bigger challenge in attracting blended finance solutions for development in particularly in Africa is less about risk and more about these projects not being packaged in a way that they are palatable to the blended finance solutions. And I'll give examples. Enabling environment, policy uncertainty, public sector infrastructure. These are things that commercial finance will not, commercial capital will not finance. And so you really have to have solutions around these things. Even if you are going to have a blended finance package that is on offer, there are so many funds today, impact investment funds and other funds, including funds that the Rockefeller Foundation has invested in, that do have resources, they do have capital for projects, but some of these things continue to get in the way. Putting in place, technical assistance to help value chain development, for example, developing farmers to a level that they can produce at a scale and a quality that is required by buyers. So some of these things really have to be addressed, and it's about aligning the public sector, about aligning philanthropy, and then going together, ensuring that everybody understands their role, and then going to the blended finance solution. I think that is an area that can be discussed and handled a lot better to address some of these things around risk. Thank you.
Thank you. Yes, I would agree with you. When you look at, there's so much capital out there. It's just finding the right projects, as you say, that are packaged properly and where the enabling environment, makes corporations and investors feel that their investment is going to, be safe. So that enabling environment is so important. Mamadou, would you like to comment?
I think that the previous speakers have been really pointing out, I think, the most critical points around really the risk and how do you manage that, how do you work on the enabling environment, etc. But perhaps one of the other aspects I would bring is really around project design and development. And what is required to really make it capital attractive. It may be an obvious one, but probably not always actually very easy to bring about. Once you've dealt with all of the other aspects, actually very critical aspects that have been said before. So how do you enable actually the right structuring that of projects that actually provide clear opportunities for all potential participants into this, and also having articulating and having a long-term view around these projects and articulating it early on. And I think that all of that is part of the strong, actually, business case that needs to be present from the beginning. So I think, but all of that is things that the community and people know how to do, but we need to bring more that expertise, I think, into emerging markets and to support actors actually to be able to do that. And also execution risks also. Also, I think that, which actually are also related to the other risks that have been actually mentioned. So I think, yes, those are really the main issues, if acted upon, can change the landscape. Yeah.
Thank you. I think I'll ask one more question and then we can move on to some of the questions we're getting from the audience. But one other thing I struggle with working with for Africa's largest bank is how do we move from pilot projects to scaling up blended capital? And I would welcome the views of the panelists on how we take the lessons we've learned over the years on proving models to unlocking the funds that are interested in the mission but sitting on the sidelines. Does our approach need to evolve? Do we need to be working together more as a community to share examples of what's working, of different structures that have been successful? How can we go from each of our organizations doing some good work on our own to actually really scaling up this sector to put all this money that's on the sidelines to good use? I don't know if the minister would like to kick us off.
I would leave TDB to kick us off.
Okay. Michael?
Thank you, Minister. No, I'd say I think part of that, from our view, part of that evolving approach for us is, I think perhaps we would start with doing more to highlight the strong achievements already made by the many players across the sector, across our continent. To show those on the sidelines that it's possible to deliver high impact, high social returns, and high financial returns, right? To sort of get them off the sidelines, to show them that it's it's safe to come into the water. In the case of TDB, we're doing this, for example, by we're launching our first sustainability report this year. Now, the report itself is new, right? It's the first time we're sort of publicly highlighting and publicizing our work in this format, and again, making it publicly available. But the work itself and the many examples contained within the report of our various interventions across our region, across various sectors, aren't new. Again, it's what we do every day. It's just our DNA. But again, I think by publicizing and highlighting this more, I think it can show people the level of impact that's already going on. Again, affordably and with showing the returns. And I think another thing you touched on is perhaps more collaboration, right, with like-minded partners. And perhaps I think on this part, it's sort of starting closer to home. So again, part of what we've been doing is targeting more African capital, right? So more African institutional capital, more African pension funds, African insurance companies, right? And I think in doing so, again, we can start by bringing along more of those already within our neighborhood on this journey with us. And I think that can be a catalytic factor to encourage even more investment and activity in the region from even further shores than right here.
Thank you. Would any of the other panelists like to comment on this issue of scale?
Yeah, I'll offer a few remarks, Maureen. I think that is the defining question that policymakers and those of us in philanthropy face today. Is the question of how do you scale these, obvious pockets of success that you have in different places? And to me, the number of actors required to make a development project successful, as opposed to, say, a purely commercial or a purely government project, but a development project that requires actors, particularly a blended finance solution. Many of the actors have got desperate interests, so they're disparate. The motivations are not always aligned. And I think the first step, and this is a particular role that we like to play at the Rockefeller Foundation, is to ensure that you have got the right partners sitting at the table, representing different interests, but that you align those interests and you align the motivations. And so I'll give you an example. I mean, we know today that there are many multinational companies operating in Africa that have made global public commitments to source their raw materials and ingredients from Africa. They've made those commitments public. Now, you know, what do you do? Here's a situation where you understand there is demand for these products. Many of them agricultural, for example. There is demand, but today, these companies can buy them cheaper from other parts of the world. You know, how do you get government, farmers, private sector together to say, we want to develop this particular value chain to support a particular company's demand, and get really, you know, granular about doing it. And I've seen success stories, but this in itself, if I just take, you know, 3 of the top big beverage companies on the continent who have made public commitments to source locally, you know, by 2030, you know, those alone, you know, could solve a lot of the challenges that we have in African agriculture. But it does require, you know, a whole choir of actors to be singing the same tune. And you do need to do that. And I think that's a particular role that that philanthropy can play in providing funding to bring together farmers, develop the value chains, working with governments to put in place the public sector infrastructure that is required to make those value chains efficient, and so on. So I think it's really a question of coordination and aligning of interests of the different actors to get these solutions at scale. Thank you.
Thank you. It's an interesting observation because I have found in some of the more development-oriented deals that Standard Bank's been involved in, it's always very helpful to have, whether it's the donor government partner or your foundation partner, to kind of step up to do the things that commercial banks aren't used to doing, whether it's the technical assistance for the farmers that you're lending to and whatnot. We all play a role. My other observation would be that I think leadership is so important. I'm curious if all of you, maybe Mamadou, you can comment on this from a Visa perspective. It's that when the leadership of an organization is very keen to utilize blended finance and to take the time to develop the approach, you know, because a lot of these things don't happen overnight. So it really does require leadership from the top to say, yes, we're going to invest the time of our staff and our people and our resources to put these approaches together. And it goes back to William's point about alignment. You know, if you've got alignment at the very top and commitment at the top, I know in our organization that makes a huge difference, knowing that our CEO, Sim Shabalala, is committed to developing the African continent. So I'm curious, Mamadou, maybe you can comment from Visa's perspective on this and how leadership plays a role.
No, thank you, Maureen. No, I think that after agreeing with all my co-panelists on the key points they made, I think that leadership is really defining. You know, it takes actually that vision and that commitment that is demonstrated actually to be able actually to move along, move others along. You know, for instance, at Visa recently, you might have heard over the past 2 weeks, we've announced our commitment, for instance, to support the digitization of 50 million SMEs over the next 3 years. It's a big and in the context of helping them bounce back, not only from the COVID, but actually build their resilience going forward. So those are the kind of bold steps actually that leadership can actually take and commit an organization into those what I would say big goals and which actually seek also transformation. But it and how do you also define that and actually make it part of your corporate and business strategy becomes also very important. And that I think is absolutely critical to move and attain those kind of goals. But it's also about how do you inspire others and actually create the platform for partnering with others so that, because those are actually beyond any individual actually organizations. It requires partnerships with different types of actors, and its leadership, expertise, and commitment actually that moves that. But having said that, to the other question of scale, I also wanted to offer something to say that I think that in developing really blended finance approach and bringing, we can look at also sources that we usually do not look at. So we can see that if you take developmental capital and all of that, it probably amounts to a mere couple of billions. But really the trillions that support development that we need are in the hands of individuals, non-institutional actually investors, who oftentimes actually do not see the opportunity or may not have the platforms actually to invest. So how can we be more innovative in actually providing the solutions and platforms that can actually mobilize those? One of the examples that I have been working on actually in my previous life is how do we enable, for instance, development institutions as TD Bank to develop more programs and do it more so often by actually taking those investments or projects that they fund that have proven to be successful, but actually whose maturation will come from in many years to come. So how do you take those, offload them from their balance sheet by bringing those non-institutional capital investment into these projects, and you can free up actually new capital for new investment. So I think that those are the kind of approaches and many that we can look at in bringing also the African private people, individuals, non-institutional actors also to be able to invest in these projects that actually will spur development and advancements also in the continents and the countries. How do we facilitate that in addition to the traditional capital that I think that we know how to mobilize? Thank you.
Thank you very much. We have a number of great questions from the audience. So I would like to start going through some of those. There's one from John Berg at USAID. And he's asking, have any of the panelists run into situations where there's a disagreement on how to handle proprietary information? Specifically, any cases where a private sector partner doesn't want to reveal trade secrets versus a government partner who is beholden to full transparency? How might such a conflict be remedied or even prevented? Does anyone have any experience with that? It looks like William's trying to get in.
Yes. I just wasn't sure if you wanted to take a few more questions, but yeah, look, I think, you know, this, I was talking about this earlier, is sometimes the motivations of the different actors in a particular project or program, you know, have got different motivations, and you've got to find alignment to ensure that each one feels safe and protected in the partnership, can contribute what is important for the success of the particular project, but at the same time not face the risk of losing important proprietary information. Now, there are companies in the private sector for whom proprietary information is absolutely critical. It is of great commercial value, and they will not risk that proprietary information you know, for anything or for anybody. And so you've got to, as government or as any other partners, have got to be able to come to the table understanding this. If this partner is critical to the success of the project, you will have to find a solution that allows the partner to keep the proprietary information confidential, but at the same time contribute to the solution that is required. Having said that, I have seen companies that compete with one another come together on projects, when there is a public good. It's all in how you package it, how you align and motivate the interests of each of the parties, and how particularly you deal with conflict. But proprietary information is an important one, because the private sector, just like governments will guard their state secrets, very, very jealously, the private sector will guard their proprietary information very, very jealously. And I think you really do have to find a solution that is workable for all the parties concerned. Thank you.
Maureen, could I come in there for a second?
Yes, Michael, please.
Yeah, so I'd say we've seen an interesting situation where, we've helped a client that has had proprietary information that is of significant value, but they actually took a very novel approach. They took a very sort of long-term approach around where they thought that industry would go, and they made the information available to the government at no cost. And this is significant. This is very valuable information. But essentially, what that did is it allowed the government, working from an informed position, to set that regulatory landscape and that business landscape on a footing that was actually attractive for the different players locally to actually come into the market and set up companies. And for that company that had that provided the proprietary information, it was actually building a market for them in the long term, because then all those companies actually became clients of theirs, right? But it took taking a 5-10 year view of what is the potential of this market and what is the actual value of this information, and how can you really monetize the value of that information by taking a really long-term view. But it's something, again, that you sort of have to look at each situation, institution, opportunity really creatively. I think there's many different ways to sort of tackle it.
Thank you. I'm going to take just a couple more questions here and then allow the panelists to comment on whichever one that they like. We have a question here from Ruthard Murphy, who's asking, in light of COVID's global impact, what are your expectations around institutional investor appetite for Africa over the next year or two, and why? We have another question here from Joel Okuemba, asking if blended finance is a model is to be realized for small, large-scale social impact programs. Where is the blender or the blending machine to deliver this? Do we need a different governance model incorporating the various stakeholders? And what would this look like in the future? And then the last question I'll take is from Dr. Katarina Lichtner, who's an MD with the Family Larson Rosenquist Foundation, asking, do all ventures targeting blended finance need to generate a financial return, or would a social enterprise approach with a clear roadmap to scalability plus the generation of a tangible social return suffice? So I'll just give the panelists a chance to comment on any of those questions that you would like to make a comment on. There's a lot there.
All right. I want to come back to the Ruthard Murphy's point about the COVID global impact and the, how could I say, the perspectives in terms of investment flows. In general, I would say all the studies from either World Bank to OECD or IMF, etc., have a pessimistic view of financial flows from developed to developing countries. I mean, for our own sake, we have done some, research analysis on the funds flows from Africa, Europe or our donor partner countries to Africa and Senegal in particular. All the results show that for the next 6 months or year ahead, the capital inflows will be reduced significantly. And the reluctance will not come only from is, I would say, the grant side, but also the loan side, and the blended finance is part of it. If you look at the stimulus package or resilience package or whatever you name it, you've seen that European Union leaders have put 4 days from Friday to Tuesday to come up with a consistent contingency package of $750 billion to support European markets. So they're not thinking yet of private investments outside those countries. Someone can tell me that it's not government money, but most of those EU or US companies, global companies, have been affected, hard hit by the crisis. Then their investment have been frozen. I would take a concrete example of oil and gas discoveries in Senegal, where the first gas was planned to become available in 2022, but BP and other US companies, Woodside, others that were in the pipeline for the investments of $3 billion starting in 2021 have decided to push back for a year or two because of the crisis. So just, these are massive multinationals I'm talking about. If you take the smaller companies or investment banks, for sure, for 100% sure, it will affect blended finance instruments over the next 6 months or a year or so. I might be pessimistic, but I'm happy to be challenged.
And would any of the other panelists like to comment on any of those questions?
Yes, if I could just comment on the second question, which I believe was whether where the blending machine is going to come from, which I think is excellent terminology. And do we need a different governance model? And the short answer to that is that I think absolutely. I think that blended finance solutions don't just work themselves out. They do require quite a lot of work ahead of it. Like I said, aligning interests. And I think Maureen and Michael, both being bankers, you will know in private sector when you're putting together a big deal. And Maureen, in investment banks, you do have a deal facilitator whose role is exactly that, to make sure that the deal happens and to make sure that if there is a disagreement or a misunderstanding, that is ironed out and you get to the stage where you sign the heads of terms or the term sheet, and then the investment can go ahead. And I think with blended finance solutions, you do need a governance model that works. And when I was at Grow Africa, we tried to establish such a governance model for agribusiness partnerships, because in agribusiness is where you find the most complex of deals, because you are including farmers, you are including government, and then you're including private sector who may be an aggregator or a processor or just buying ingredients. And so we try to create a governance model for countries to create country agribusiness partnerships that involve government, involve private sector, and involve farmers. And it would start off at the lowest level to agree the deal, and then it will be approved at a higher level by the government officials, and especially where the particular project was policy heavy or public sector infrastructure heavy, you needed government approval and government commitment to policy reform or to public sector infrastructure investment. And so you had to get it approved at the highest level politically. And so, yes, I think that's an excellent question. It's pertinent. And if we are going to do blended finance solutions at scale, I think the governments should look at establishing governance models in countries for particular sectors. And I think agribusiness is just a great place to start. Thank you.
Thank you. Did any of the other panelists want to comment on any of the questions from the audience? Well, I can make one comment on the institutional investors. I think we have seen quite a bit of outflows from the portfolio investors. interestingly enough, there is some interest in some of the institutional investors who are taking a longer view, and that the continent provides opportunities for greater yield. So it's all about the hunt for yield, and pension funds and others who are looking for ways to get a better return. We have partnered up with USAID and MEDA advisors to try and look at structures that we can create at Standard Bank that could allow these institutional investors to start investing in Africa. And it's the beginning of a journey, and we'll have to see exactly how that all goes. But we are finding that there's an interest and a willingness to look at investments in the continent, because when structured properly, the returns are higher, and you actually can have a nice impact while you're making money for your pensioners. So Flory, I think we might be out of time here. Would you like to close us out? I think it's been a really interesting discussion so far, and I've really enjoyed this conversation with our panelists and the varying different perspectives you all have on blended finance. Very interesting.
Yes. I don't know if they can unblock me on the video team. While they're working on that, let me just say that yes. So in closing, I just want to thank all of you, the minister and all of you, for a really interesting and excellent broad-ranging discussion on this important topic of blended finance. You've really given us some interesting insights on how development capital can be leveraged to achieve tangible impact. And we want to thank you for spending the time and sharing your insights with us. Please know that you have a partner in CCA. We look forward to following up with you individually and collectively on specific ways CCA can collaborate with your institutions in implementing some of the solutions that you presented. So, not just the talk here, but how can we help you in the walk? Thank you again for taking the time to speak with us today. Before I let everyone go, just very quickly, I'm also delighted to invite you to join us next Tuesday, July 28th at 10 a.m. Eastern Standard Time for our third and final session on Blended Finance 2.0, Mobilizing Commercial Capital. And we've prepared a great panel of speakers for you with, for example, the Honorable Minister of Finance, Budget and National Planning of Nigeria, Zainab Ahmed. We have Olivier Ewek, the head of Sub-Saharan Africa, Public Sector Global Corporate Banking at JP Morgan Chase. We have Donna Sims Wilson, who's the Chief Operating Officer at KA Capital Management. And we have Samela Zubairu, President and CEO of the Africa Finance Corporation. And we're pleased that Peter Sullivan, the Managing Director and Head of Public Sector Africa of Citi, will moderate that session for us. So again, thank you all for your participation. Please stay healthy and safe and enjoy the rest of your week.
Thank you, everyone.
Thank you. Thanks so much.